Some businesses need huge factories. Others run with almost no physical assets. So the real question is, how efficiently is a company using its assets to generate profit? That's what ROA tells you. ROA stands for Return on Assets. It answers one simple question. For every $1 of assets a company owns, how much profit is it generating? ROA looks at asset efficiency, not ownership returns and not capital structure. The formula for ROA is net profit divided by total assets multiplied by 100. Assets include everything the company owns: plants, machinery, inventory, and cash. Let's take a simple example. A company earns $10 in net profit. Its total assets are $200. That gives an ROA of 5%. That means for every $100 of assets, the company generates $5 in profit. Whether this is good or bad depends on the industry. ROA works best for manufacturing, logistics, capital-intensive businesses. These businesses rely heavily on assets, so ROA reveals how well those assets are used. ROA can mislead when comparing asset-light with asset-heavy businesses, analyzing banks and financial institutions. Different business models mean different asset structures. Investors use ROA to understand asset productivity, operational efficiency, capital intensity. A rising ROA over time usually indicates improving efficiency, better use of existing assets. That's a positive signal. This is where ROA really makes sense. Investors rarely use ROA on its own. ROA works best alongside ROCE and ROE. ROCE shows overall business quality. ROE shows shareholder returns. ROA shows how efficiently assets are used. Together, they answer, is the business efficient? Is capital being used well? Are shareholders benefiting? ROA completes the picture. It doesn't replace the others. Use ROA to judge efficiency, not to compare different business models. Follow Finerix. Understand money better.